The stock market, economic, and financial conditions are in a downtrend. We're going to explore what we can expect from the retirement reboot, so stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. On this channel, we investigate Social Security, investing for retirement, when to retirement, how much to save for retirement, and much more. Now, right now, we're going through a financial, economic, and stock market downtrend. And many folks are concerned what's going to happen next. So I'm calling this a retirement reboot. We've got to rethink what's going on with our investments right now. We got to weave and maneuver our way through this situation so we don't lose money. So we're going to investigate our current situation and what we think is headed going forward. Let's first take a look at where we're at in the economic cycle right now. Right now, we're somewhere in this late stage of economic growth. Right now, we're seeing growth moderating, credit tightens. We're seeing that the Federal Reserve is raising interest rates, earnings under pressure. We're going to get numerous companies announcing earnings over the next few weeks. This is going to be very important to where our stock market heads from this point on. Eventually, based on various economic conditions that we're facing right now, we could be facing some type of a recession. That would be the last stage of the economic growth cycle. So right now we're in this economic and stock market downtrend caused by high inflation and also the sudden and skyrocketing increase in interest rates. With this high inflation and the skyrocketing interest rates, we're now in an economic or retirement reboot. We're no longer in the bull market that we've been in the last 10 plus years. The main driver to stocks and the stock market in general is earnings. If companies are making money, their stocks will rise. If they're losing money, they will continue to drop until they reach a point where it becomes a new buying opportunity. We're looking at a chart of the S&P 500 price to earnings ratio. What they're saying here is right now the price to earnings ratio for the S&P 500 is higher than in past bear market cycles. So right now it's around 18 approximately. In other past bear market cycles, the S&P 500 price to earnings ratio dropped to areas around 15 or even lower. Here's an interesting chart to look at. This is the Buffett indicator, value versus historical trend since 1990. This is comparing the ratio of market value to GDP. And you can see where we were at the high of our market, and they compared that to the high of the internet bubble back in the year 2000. Now we are dropping right now, but until we achieve this zero line, we really haven't gotten back to the point of equilibrium. Here's a very interesting chart we want to take a look at. Now there's a lot of little lines on this. I'm going to make this very, very easy to understand. This chart compares past bear markets to our current bear market situation. Here's the red line. That's the S&P 500 as we stand now. It's down about 20%. If we compare this to the 2002 bear market, that market was down about 35% or so. And then if we compare this to the 2007-2008 bear market, that was down 50%. When we compare this to past previous bear markets, you can see that we have not reached the lows of those previous periods. We're looking at the top 10 holdings for the S&P 500 Index SPY ETF, SPY. These stocks and thousands of others will be reporting earnings over the next few weeks. Depending on how these stocks perform after they give their earnings guidance will be very important, along with other factors like this. We will also be watching very closely to how the markets respond to the next Fed rate increase. Now, a few companies have already announced their earnings. JP Morgan here, earnings fell 28%. But it's not all bad. Citigroup here said their shares surged 14% after they beat profit estimates. We're looking at a one-year seasonal cycle pattern for the Dow Jones Industrials. Typically, buying opportunities come around in the August to October area. Of course, we can't guarantee anything. There's just way too many things going on here. We have interest rates increasing. We have earnings announcements. But if the market starts to sense later in the year that the Fed has a handle on this inflation, it could lead to a higher market towards the end of the year. Now, the next question we all have to answer, is there another shoe to drop on the stock market? Is the stock market going lower? Let me know what you think. Is the market going lower, or are we going to go higher from this point forward? Also, there's lots of obstacles to the market in the next couple of weeks. One, we have rising interest rates, and two, we have earnings announcements. Depending on the guidance on these earnings announcements will depend on whether these stocks go up or go down. So it's going to be real key on these earnings guidance going forward. So I hope you found this information useful. If you have any questions or comments, leave a comment. Stay tuned for our next episode.